Good morning. We are initiating a deep dive equity analysis on Snowflake Inc., ticker SNOW. Currently capitalizing at approximately $50 billion, Snowflake represents the definitive pure play on the secular shift to the data cloud. While the stock has seen significant multiple compression since its IPO highs, the fundamental thesis rests on its unique consumption-based revenue model and its transition from a mere data warehouse to a comprehensive application platform. Today, we will dissect the company's valuation framework, the implications of CEO Sridhar Ramaswamy's pivot towards AI, and whether the current valuation prices in the decelerating net revenue retention. We are looking beyond the hype to assess the risk-adjusted return profile for institutional capital. The core of the bull thesis lies in Snowflake's architecture, the decoupling of storage and compute. Unlike legacy on-premise solutions or early cloud adapters, Snowflake allows customers to scale storage and compute independently across all three major public clouds, AWS, Azure, and GCP. This multi-cluster shared data architecture eliminates data silos, creating what we call data gravity. For the investor, this translates to high switching costs. Once an enterprise migrates 50 terabytes of data into Snowflake's ecosystem, the friction to leave becomes operationally prohibitive, creating a defensible moat despite intense competition. Management projects a total addressable market of approximately $290 billion by 2027. We must scrutinize this projection. The initial TAM was defined by data warehousing. However, the expansion into data engineering, cybersecurity workloads, and specifically the data cloud for application development materially expands this ceiling. The capture of legacy on-premise spend is the primary driver. We are currently observing a rotation where IT budgets are prioritizing AI-ready data estates. If Snowflake captures just 5% of the global 2000s AI data spend, our sensitivity analysis suggests a revenue upside deviation of 15% above current consensus estimates. Turning to the quantitative health metrics, net revenue retention, or NRR, has historically been Snowflake's crown jewel, peaking above 170%. We are now seeing a normalization toward the 120–130% range as the law of large numbers takes effect and enterprise optimization kicks in. Investors should pivot their attention to RPO, remaining performance obligations. RPO represents deferred revenue and future contract value. A divergence where RPO growth outpaces revenue growth is a leading indicator of demand acceleration. Conversely, if RPO growth decelerates faster than revenue, it signals a shrinking pipeline. Currently, we are monitoring a stabilization in consumption patterns after significant optimization headwinds. Snowflake does not operate in a vacuum. The primary existential threat is Databricks. Historically, Snowflake owned the SQL data warehouse, while Databricks dominated the data science and Spark workloads. These lanes are merging. Databricks is moving into warehousing with their lakehouse concept, and Snowflake is aggressively moving into Python and AI with Snowpark. We also cannot ignore the hyperscalers, AWS Redshift, Google BigQuery, and Azure Synapse. While they are partners, they are also competitors. Our channel checks indicate that while hyperscalers offer lower costs, Snowflake retains a premium valuation due to its cross-cloud neutrality and superior ease of use. Let's discuss margins. Snowflake exhibits a classic high-growth software profile, robust non-GAAP margins masking GAAP losses due to stock-based compensation. However, the free cash flow story is compelling. The company generates significant cash, with FCF margins frequently exceeding 25%. This is a critical buffer in a high-interest rate environment. The path to GAAP profitability is the next major catalyst. Investors must model the trajectory of operating leverage. Specifically, can S&M, sales and marketing, expenses decrease as a percentage of revenue while maintaining 20 to 30% top-line growth? That is the multi-billion-dollar question. Valuation has been the primary bear argument since the IPO. Snowflake once traded at over 50x forward sales. Today, it trades at a fraction of that, though still at a premium to the BVP Cloud Index. We value S&O using an EV over revenue multiple relative to growth, adjusted for FCF generation, often referred to as the Rule of 40. Currently, S&O passes the rule of 40 easily. However, relative to peers like MongoDB or Datadog, the premium has narrowed. Our proprietary DCF model assumes a terminal growth rate of 4% and a WACC of 10.5%. The sensitivity of the stock price to interest rates remains high due to the duration of its cash flows. The bull case is predicated on generative AI. Large language models require massive, clean datasets. Snowflake is positioning itself not just as a storage locker, but as the engine room for enterprise AI via Cortex and Snowpark. The thesis suggests that as enterprises build proprietary LLMs, they will do so where the data already lives, to avoid egress fees and latency. If Snowflake successfully pivots to become the default data app platform under CEO Ramaswamy, we can see a re-acceleration of revenue growth back toward the 30–35% range, justifying multiple expansion. Conversely, the bear case is substantial. First, stock-based compensation, or SBC, remains alarmingly high, consistently diluting existing shareholders. Second, the iceberg tables feature, which allows customers to store data in cheaper external storage while using Snowflake's compute, could cannibalize storage revenue. Third, there's the risk of commoditization. If data warehouse performance becomes good enough across cheaper competitors, Snowflake's premium pricing power erodes. Finally, the consumption model acts as a double-edged sword. In a recession, revenue can evaporate instantly as companies dial down usage, unlike sticky subscription seats. In conclusion, Snowflake remains a high-beta, high-quality asset undergoing a critical identity transition. We view the company as a long for patient capital with a 3 to 5 year horizon, betting on the convergence of data and AI. However, for short-term traders, the stock remains range-bound, subject to macro data spending reports. Our base case price target implies a 12x forward sales multiple. We advise an accumulation strategy on pullbacks, strictly monitoring NRR stabilization. The days of hypergrowth at any cost are over. The era of efficient, AI-driven scale has begun.